everybody. My name is Mathew Owens, and welcome to Masters of Real Estate. Today, I have an amazing long-term friend of mine on this for you guys, where we're going to talk all about self-directed IRAs. Karin Hall and I have been working together for, gosh, I think it's got to be 15 plus years now.
Yeah,
And
more than that. Yeah.
it's been an amazing relationship. She's helped educate me a ton about retirement investing and the fact that you can actually take your own retirement from your job, or after you quit that job, you can self-direct your money into real estate or any other asset class you want. You don't have to rely on IRAs, 401k, traditional investments like stocks, bonds, mutual funds, and things like that. You can actually take control of your own financial future and be able to self-direct it into real estate. So this is one of my favorite topics because, one, I don't like paying the government money and taxes. And this is a great way to defer those taxes. And you can invest in Roth IRAs as well as self-directed 401ks, Roth 401ks, Roth IRAs, all kinds of different stuff, and pension plans. There's all different types that you can invest in. And so you have options to develop your own financial future and take control of your financial future, so that you're not just leaving it up to someone else that's going to do that workload for you, or, you know, hope that that broker knows what they're doing and being at the whim of the stock market and those ups and downs, without true cash flow streams that really get you to true retirement, where you're not going to have to deplete your own money during retirement. You can actually come out and develop a cash flow stream inside your retirement to live off of, which is the whole idea behind, you know, true retirement. So Karin, thank you so much for being on with me today. Can you talk a little bit about your background, how you got started with UDirect, which is your own company now? That's amazing.
It is. Yeah. You know, it's not like you grow up. Like when I was a little girl, I didn't think, wow, I really want to self-direct some IRAs when I get older. You know, that wasn't really, I wanted to be an oceanographer. Okay.
Nice.
So you be in a scuba suit every day or self-direct IRAs. Here I am. Right. So I went to college, and when I was in school, I got involved with the radio station. I was a radio announcer for 17 years, which was obviously a logical transition period a platform to jump off into finance. But I got involved in real estate. Like so many of us do, we do one thing and then we get into real estate for some reason. So, started as a realtor and a property manager, and then got into loan servicing and loan origination, and just did a whole bunch of things. I had to one time take someone to court to evict them for a landlord. I have my own rental properties now. I've had them in the past. So all this real estate knowledge and mortgage knowledge was the exact perfect thing to give me all the tools that I needed to run this business. And that is to understand the underlying assets. It's always real estate, it seems like, or unless it's precious metals, or very, very few things that are alternative assets aren't somehow tied to real estate. Right. And because I had that base of knowledge, and plus working in customer service, loan servicing, I understood quite a bit about, the inflow of calls and helping customers and all that. So everything I've done in my life leading up to this point has led to this point, and here we are.
And when you first got started in this space, was there a lot of knowledge out there about what self-directed IRA investing was in the first place? And how come that hasn't happened more?
Yeah. Well, okay, so you and I met like in 2007.
Yeah.
And remember, and so that was the beginning of the Great Recession.
Right.
And so that was a time when people like you, people who are real estate investors, are saying, wait a minute, I can't buy any more real estate. I've capped out on the number of loans I can get. The banks aren't lending. Where can I get some cash? And then everybody's like, oh my gosh, well, now there's something like a $40 trillion pool of funds in retirement accounts that people can tap into.
Right. So
other people's money, right? And nobody knew about self-directed IRAs. So it was nice being the most popular kid at the party for a while until everybody kind of caught up, and super fun. And this was a source of money, and not just money for deals, but like you're doing your deal, Matt, and that's great. So you're also helping someone else build their retirement simultaneously. So you're doing something great for yourself and your family and your company, but you're also doing something great for someone's retirement. when that investment pays off and pays, as agreed. And so it's just kind of a win-win thing. It's really taken off, but it is also still kind of a best kept secret. So a lot of people don't know about this. I'm always surprised.
Yeah, it's interesting because, obviously the education is not transparent to everybody out there. It's not, there's a lot more of it now with, YouTube videos and, videos out there, a lot of education that has happened over the last, 15 years or 10 years. But, historically, and even now, it's still kind of an unknown knowledge that you can actually take your own retirement and actually control it. I have my own self-directed 401k, my own health self-directed health savings account as well, which is amazing because now you can even develop and invest your own health savings account to develop enough cushion to cover all of your medical expenses long term, which is
Tax-free.
amazing, right? And one of the biggest underfunded insurances that there are is like disability insurance and and that kind of stuff. And
And
so
long-term care.
yeah, long-term care and that type of thing. And so being able to control that is amazing. I have a ton of clients that have worked with you in the past with UDirect IRA services and are super happy with what you guys do as well. And you guys have grown. Now you have online systems. A lot of the other outside companies out there might have online systems too. But I want you to talk about, what makes a good custodian and administrator here, because it's so important. There's a lot of places. It's not just as simple as, hey, let's go and transfer my money into this new custodian, which is very similar to, like, I'll call it a Fidelity or a Schwab or, a different type of account.
Mhm.
It's just a different type of account. It's not, and you don't take crazy fees and all this stuff like a lot of these other companies do, but
Right.
understanding that kind of transition and who are you now putting your money with and how do you choose that right custodian, because there's a ton of them out there and some of them are kind of scary, so what is your opinion on how do you do your homework on that right custodian and what are the important factors to consider?
Yeah, what a great question. I sit on the board of directors for the Retirement Industry Trust Association.
Okay.
And so if I was choosing a custodian or someone to handle my self-directed IRA, that's where I would start because it's a large group. It's the majority of the industry, really, but of people that really care and are on the cutting edge of what's happening in Washington. It's a bit of a what do you call, like a lobby
Right.
to lobby for retirement savers, and we've really done a lot of amazing things. I've been a part of RITA for 11 years now, and it's
That's
just
awesome.
it's fabulous because I've learned so much, and it helps me. It gives me a position to advocate for our account holders. So I'd
Right.
start there, but I think when it comes to self-directed IRAs, really it's not a commodity, but it kind of is. So number one, it's fees. How much are you going to spend? What does it cost? Because all the fees come out of your ROI, don't they? So that's why we keep our fees low. It's always like a flat fee. Now a little commercial there. But the other thing is service. And so you want to read the reviews. You want to talk to other people. Who do they use? Who do they like? And we have a lot of good reviews. I think too, what is a strength of UDirect IRA services is that I hire pretty much most of our employees have a background in, like one has been an appraiser or one worked for a lawyer, or a lot of them were in the real estate industry. So they understand the jargon, they
Right.
understand what you're doing. When you want to hypothecate a note, they don't flip out like, well, what does that mean? I mean, these are people
Right.
that have already had a career in the real estate industry and really understand your asset class.
So what I'm hearing, the primary things to consider, one is fee structure, right? Because
Mhm.
some of them, and it looks like I lost my video here. There we go. Um, so some of them are very fee heavy. So it depends on how much assets you have, how many assets you have, all of those types of factors, and the scale could go up versus like a flat fee structure like yours, where very transparent and actually way cheaper than the Fidelities and the Schwabs and all those that actually take a considerable portion of your profits in fees as they trade for you in mutual funds. And, it's
Yeah,
like something like 60% plus of the actual long-term profits through those fees that aren't even disclosed to you. I think they might be required now, but historically they haven't been. And,
right.
now being able to see, hey, you got this one flat fee, on an annual basis. And being able to understand what those fee structures are super important when you're determining the right custodian or administrator to work with, right? And then on
It
top of
really
that,
is.
the customer service aspect of this and the process aspect of this, because you get a deal under contract, you want to invest in a deal, you need to be able to make sure that that is lined up and easy to do and easy to get transitioned and money moved over, so that way you don't have headaches. It doesn't blow up a deal on you because you're working with some custodian that takes, you know, a month to get a deal funded or something like that, which is crazy.
Real estate doesn't work
Right.
that way, does it?
Right, right. You got contract deadlines and things like
Yeah.
that. So, and it doesn't necessarily have to be real estate. You know, a lot of people like you see all the time, they invest in promissory notes secured by
Mhm.
real estate. They invest in rental properties directly and own the properties directly, of course. They invest in other partnerships or syndications related to real estate, but also non-real estate related type stuff too.
Sure.
There might be some taxes associated with it you have to be careful of, and we'll talk about that in a second. But being
Okay.
able to invest as a limited partner in different, you know, business ventures or different opportunities is available out there to do that. And there's some prohibited type things you got to be aware of too. But it's amazing what you can invest in. Are there anything else that you can think of that you can't invest in outside of you know, typical real estate ventures that you're talking about?
I mean, you just gave such a comprehensive list. It's alternative assets. So, you know, when it comes to real estate, it could be, you mentioned mobile homes, it could be multifamily, self-storage, raw land, even
Right,
farmland. It could be a lot of different things. But again, there's precious metals, even cryptocurrency, although it's the Wild West with crypto, pretty risky, but you
right,
know, it's your call. That's why it's self-directed. You get to pick.
right.
Um, but the number one asset class for self-directed IRAs is syndications. So that is the number one thing, the number one asset that our account holders and industry-wide will invest in.
Okay, gotcha. And you know, I think being able to, you know, understand what assets, you know, an administrator is comfortable with and structures
Yes.
is important as well when you're, you know, choosing a specific administrator. But it's amazing all the different things that you can actually invest in, like I said, and control your future. There are some things like we had mentioned before, like life insurance and collectibles, those types of things are
Those are
typically
prohibited.
prohibited, right? So you got to be careful there. There's also some you know, prohibited parties involved. And just for the record, everybody, you have to get your own tax advice, legal advice here from both of
Yes.
us. We both know what we're talking about. At the same time, you have to get your own individualized advice, right? Don't take
Yeah.
what we're saying as specific advice for your situation. You have to have a professional take a look at your situation. Don't ever just take a YouTube video's advice without doing research, you know,
Or
or
we're
a
not a
podcast
fiduciary.
advice without
You know,
research, right?
yeah, so
Yeah,
we're not your fiduciary. That's exactly right. We don't
right.
necessarily give investment advice, but you know, we're helping you, kind of pointing you in the way of where you can find the investment advice that you need.
Right, absolutely. And so what are some of the kind of problems that can come up that you have to be careful of when you're doing business with people or deciding on an investment?
Wow, due diligence. I know you and I have gone back and forth on due diligence over the years and had events and so forth because it's so fascinating. It's easy to open an account. You just, you know, fill out a form, you transfer your money, you pick an investment. I mean, open fund invest is easy, right? But
Yeah,
what's challenging is getting an account set up isn't hard.
right.
What's hard is doing the due diligence. So I think that's what you're talking about. And I know, Matt, you could just by yourself write a book on due diligence, but you definitely want to make sure you do it. I mean, check
Right.
out who are you investing with? What is the asset? Google that person if it's another person. Make sure you understand the underlying asset. And something I was talking about with an attorney at lunch last week is that people say, "Oh, it's a passive investment." That doesn't all that means is that you're not in there swinging the hammers. It doesn't mean you
Right.
just set it and forget it. It's not passive in that regard.
Right.
If you care about your money, you're going to make sure your payments arrive as, you know, it's paid as agreed. You're going to make sure that you contact that advisor from time to time, the person you invested with, and say, "Hey, how's it going?" And make sure that they know that you're there. You know, that you're talking to them. Make sure you get your annual docs if maybe you're getting a K1 or something
Right.
like that.
I
So
think,
due diligence is the number one. That's the number one key to successful self-directed investing.
and that's a really, really good point to say, full stop. You are now responsible with a
Yes.
self-directed IRA for your own investments. This is not a Fidelity check, I want high risk, low risk, medium risk type situation,
Right.
and you do nothing, right? This is, you are going to evaluate, do the homework on, and understand the specific investments that you're investing in, and you're responsible. If you lose your money, you lost your money. You're not investing with someone else that's going to go, do all this homework for you. If anybody wants, I have a 200-point due diligence checklist on our website,
Only 200, huh?
MathewOwens.com. 200-point, yeah, and it's actually
Oh,
expanding now too. So it depends on asset class and things like that. But so that homework piece is extremely important. If you're not ready to take control of your own future and be able to really do the homework that's required on these deals to understand them, think about the risks, the economy as a whole, and make those investment decisions, you should be getting outside financial advice on each one of those. You should be getting outside legal advice on every investment that you do. That is the type of thing I'm talking about. So there is some extra work involved when you're analyzing these, for sure,
sure.
and doing background checks on criminal checks on operators, and understanding their underlying assumptions. There's so much that goes into that, and I have multiple other YouTube videos or podcasts that we talk about these topics. Okay, so you can get that information. It's out there already. If you email us, we can send you links to those things. Very easy to understand. What I'd really like to dive deeper into is the specific prohibited transactions
Okay.
that you're not allowed to do, because this is a retirement vehicle. You can't commingle with yourself. So can you talk a little bit about some of those prohibited parties and prohibited type transactions that you can't do?
Sure, of course. I mean, it starts with the rule book, right? The rule book, where it's all written down so you can read it, is the IRS, the Internal Revenue Code, IRC,
Okay.
Internal Revenue Code. So it's IRC 4975, okay? It's all written, but we'll talk about it. And so prohibited transactions largely circle around people who are disallowed to your IRA. So some people are allowed, some people disallowed. So this is where I genuflect, right? It's your parents and grandparents, yourself and your spouse and your kids and your grandkids, if you think of it like that.
Right.
So so the immediate family, if you passed away, who would get your estate if you died without a will or something?
Right.
These people in line. So what this means is the self-directed IRA, I call it the game of keep away, right? Keep away from prohibited transactions. And you keep away by keeping arm's length. So you're not allowed to have personal benefit from your IRA, indirect benefit. You're not allowed to just have any, present benefit at all. So for example, your IRA doesn't make a loan so that you can go, buy a car. You don't do that. Not with an IRA. Your IRA does not make a loan to your spouse so that they could start a business. That is a prohibited party receiving personal benefit from your IRA, prohibited transaction. So there are more too. It's like offering services to the plan. So if you are an asset sponsor, maybe you've got like a Reg D offering or something, syndication, and you think, wow, I'm going to take my IRA and invest in my syndication. No, because you are a decision maker and you're affecting that transaction. So you can't invest your own retirement in your own deals. If you have any questions, that's what we're here for. Just pick up the phone or email us, info@udirectira.com. Does it sound like a prohibited transaction? And we'll go deep with you on that.
And that's really important to understand.
Yeah.
Understanding the present benefit rule is very key, which basically just means you can't benefit from your retirement account personally, and your retirement account can't benefit from you personally and your assets. So you couldn't go build a house or renovate a house next door to your house, because it'll increase the value of your house too, right?
Yeah, that's the tricky one.
Right.
Yeah, and I think we should talk about what happens when you commit a prohibited transaction.
Yeah, absolutely. Please.
So in all the years I've been in this, I've only seen maybe like half a dozen of these, like where the IRS was talking to one of our account holders and really calling them on it. It doesn't happen very often. But when it does, it usually makes some headlines. So what happens if your IRA does commit a prohibited transaction is that tax protected bubble of your IRA bursts, and now that money becomes like you earned that money.
Right.
So if you commit a prohibited transaction, you probably owe back taxes, and you probably also owe some excise. So that's the worst case scenario. I rarely see that ever happen.
Right.
And it doesn't happen because we're talking to people. We're looking at your deal like you're looking at your deal. And if we see a prohibited transaction, we're going to tell you.
Right.
But really the responsibility is on the account holder not to commit one. But we're going to definitely educate you by things like this lovely podcast or our blog or whatever. And so many different ways that we reach out and speak and educate the public about, how to use a self-directed IRA responsibly.
Right. I think, it's not going to be that hard to not do these things for sure. I think it's important to scare people a little bit and to realize that, hey, don't be stupid, do it the right way. Make sure you understand you can't do business with parents, kids, grandkids, grandparents, wives, husbands, that kind of thing, but aunts, uncles, brothers, sisters, maybe okay. You want to make sure there's no, additional benefit you're getting back and forth or anything like that. The present benefit rule, you want to make sure that, you're not self-dealing to yourself on your own deal or, selling a property from your IRA to yourself, those types
or
of
you
things.
Take it from your IRA, then you sell it to your C Corp, which moves it to your LLC, and you think you're hiding it. You're not. It's a completely invisible.
Yeah, don't get cute with this stuff. Make
Indirect.
sure.
Yeah, don't get cute. If you care about your money.
And then I think there's some taxes people should definitely understand. We have a UDFI tax and a UBIT tax. Can you kind of just generally explain what those are?
Yeah. I think I'll start again with the rule book because it just gives our listeners a way to kind of, just jot this down. Because then if you want, after this event, if you want to go deep on it, this is where you go. It's irs.gov, irs.gov, and you look up publication 598. That's the rule book. Everything you want to know, written by the IRS themselves. Beautiful. It's easy to read. So there's UBIT and UDFI. UBIT is unrelated business income tax, and that comes into play normally when your IRA invests in an active business. It used to be back in the day when people were buying properties on tape and people were doing 20 flips in their IRA. That's running an active business.
Right.
And so people were getting hit with UBIT at that time. Now it's more like if your IRA were to buy a franchise of something or you're actually running a business. So that's when unrelated business income tax comes into play. UDFI is like a cousin or twin tax. That's unrelated debt financed income tax. So an IRA can borrow money, non-recourse, so it has to be non-recourse. And when your IRA borrows money, the proceeds that come to the IRA because of debt are subject to this tax. So say you take the 70% IRA money, 30% leverage, then that means that 30% of the money that comes in is subject to this tax. So before you take out a non-recourse loan, talk to your tax advisor. Say, this is what I'm going to do. Do you know how to file a 990-T, which is the tax form?
Right.
Do you understand UDFI? And make sure you educate them because your tax person is really your partner as an investor. They're a huge partner in your success.
Absolutely. And this can get really intricate. So having the right tax advisor on this is very key, of course. And so UBIT, unrelated business income tax, is the business income tax if you're running a business. Yeah. UDFI, unrelated debt financed income tax, is the debt piece of this. Now, you're also, if you're going to get taxed, if you borrow, say, 50% of the asset against 50% of the asset, then you'll get taxed on 50% of the net income associated with that as well. But you also have depreciation against that 50%, or 50% of the depreciation allocation gets thrown in there. Right. So it really is a very minor amount at the end of the day, depending on how much you have inside there. And when we say IRAs, we're really meaning IRAs, 401ks, Roth IRAs, Roth 401ks, health savings accounts, pension plans, all these types of things can be self-directed into these strategies. And there's a little difference with self-directed 401ks, in which case UDFI does not apply, is my understanding. Talk to your advisor. Yeah, you have to be careful about that. But go through and understand these underlying factors. And so, in addition to that, there's one additional structure that I want to mention to people that I think is extremely important. And that's the checkbook controlled LLC. Can you talk about that a little bit and how that works and what that structure looks like?
I mean, I can give you the really simplified explanation and talk about some of the things to watch out for. So basically, you have self-directed IRA, it's got money in it, right? Self-directed IRA account that's funded. You have a third party create a special purpose LLC. So if you go to the Secretary of State and create an LLC, your IRA can't use that because your IRA cannot invest in an asset you own. Okay, right. So it can't be in your name. A third party is going to create this special purpose LLC, has special language in it. Your IRA has money, your IRA buys 100% of the initial shares of that LLC, right? So then the money goes from the IRA into the LLC's checking account. All right, so here's what it looks like. IRA owns the LLC like this, okay? So you have to have an IRA. The LLC is an asset of the IRA.
Right.
So every year you tell us how much this LLC is worth, and we will report the value of your IRA then to Washington through a 1099. We file a 1099 if there's money going back and forth, and also our 5498 about the value. So that's kind of how it works. Now, if you're going to do this, it can be really great for buying tax liens, because when you buy tax liens, you buy a lot of them. And that can lead to a lot of small fees, transaction fees. So a lot of people like it for that, or buying properties at auction. It's right. When we first started, Matt, it wasn't this easy to get money in and out of your IRA as it is now with our business platform. Right. So it's very easy. But if you're going to do this, it's with great power comes great responsibility.
Yes.
And as you know, Matt, the IRS has recently acquired a lot of money to hire a lot of agents. And guess what they're going to look for? They're going to look for the low-hanging fruit. Right. And it's in these IRA-owned LLCs, because you can only use the money to buy an asset or pay the expenses of the asset owned by the LLC. That's it. Right. Not for education, not for traveling, not for gas. It's just assets and asset-related expenses. Because if you make a mistake once, it could be game over. Right. So the way that you keep that from happening is to keep really great records, have QuickBooks or Quicken or some sort of online kind of thing. Just be really clean with your books. So if you get audited, you can say, hey, look, I follow the rules. Here it is. Boom. They'll say, okay, you're right. You did. No problem. And that's what you want. And
the primary benefits of opening this IRA-owned LLC. So you're just having an attorney that has that special purpose language, open it up. The owner of that entity of that LLC is the IRA in the first place. They're going to own that. They're going to basically fund the money into that LLC. So now your LLC has the capital in there. Maybe it doesn't have any assets just yet, has the capital in there. You have checkbook control now, as you are the signer and manager of that LLC to direct the investments. You can't get reimbursed. You can't go through and commingle as well, but you can manage the assets of that LLC. Then you're going to go and maybe you're going to buy a bunch of properties with it, and you don't want to have to deal with asking the custodian to get all these new checks in and cut property management checks or property tax and insurance checks and all these other costs that are for running a property, right? Or you're going to invest in a bunch of promissory notes that are going to pay off all the time and consistently be doing a lot of activity. So if you have this LLC, it makes it a lot easier to go and transact your business if there's a lot of activity. But if you have minimal activity, like it's a syndication investment that you're going to go invest in, and you're going to be passive, and you're getting a check every quarter and not dealing with any operations, not dealing with all these checks all the time and operational expenses, then it makes sense, hey, just keep it right directly into your IRA. And then also this LLC gives you a layer of liability protection as well of that asset, of that hard asset, as well. So being able to structure this is amazing and key to to doing more complex, more frequent type transactions as well. Keep in mind, be very, very careful not to have it be considered running a business. It should be more passive type investments versus anything active. If you're fixing and flipping a bunch of houses, that is considered a business. So you want to be careful. Maybe you might get lucky on one or two, but if they audit you, you're going to have a problem. You better be able to back that up about what is your intent. Was your intent to flip? Was your intent to hold long-term? Did you get that property rented out? So talk to your CPA or financial advisor on those specifics if you're planning on doing certain assets inside of your own retirement vehicles, which the LLC owned by your IRA is considered your retirement vehicle. So really, really key. So what are the crazy things people try to pull, Karen? I'm very curious, because I know there's got to be some stories here.
No, this is my new favorite. Okay, this is my new favorite. And I really have to say this because it's so common, and I don't know why I've been talking about it more before. But say, for example, you invest in a syndication, and it is awesome. So you get this asset, whatever asset sponsor, and you get into this deal, super, and it paid off, and it's great, super happy with how it performed. So and you get a full payout, you get a liquidity event. And so instead of sending that money back to the IRA where it belongs, you tell the asset sponsor, just roll it on into the next one. Big mistake. The money needs to go from that asset sponsor into your IRA. And if you want to invest in the next deal, great, do it. That's fabulous. But you have to go through the process again, so the custodian knows what asset it is got custody of. Right. Because if you take asset A and you roll it into asset B, and then 10 years later you come to us and you say, oh yeah, why doesn't it say anything about asset B in my account? It's like, well, because you took constructive use of your IRA. Right. You acted as the custodian, and you made decisions of that had, so basically that means it's not an IRA anymore, because you just took constructive use of it. And we don't have custody of that asset, do we? It's something you decided to do. And that's a really important thing to talk about. Whenever an asset pays off, the money goes back in the IRA, and then it can go out into your next deal, and you can still have the same net result, just a couple of little transactions in between. And that's the difference between committing a prohibited transaction and not.
Yeah, definitely being able to pay it off and say, this is the payoff, custodian, and now let's reinvest into the new deal is super important. Otherwise, there's no way to track this stuff. There's no way to be able to know, what the values are for the valuation each year, because you have to report valuation once a year. All those types of things become super complex. And if you did that over and over and over again, all of a sudden it gets really, shady and, scary to be able to, for the accounting side of things. Right. So in reporting
and that's why you call us, call us and talk to us. Say, hey, if something happens in all the years that we've done this, there isn't something that hasn't had there is a solution for every problem. Sometimes it's not the solution you want, but most of the time it is. There's a way to fix it. Sometimes like a prohibited transaction, that's really, you can't really unring that bell. So again, don't just jump into this with both feet until you've taken some time to really learn about it, talk to people who have done it, talk to us, talk to Matt. What does this look like? And we're always happy to educate you.
That's awesome. How can people get a hold of you, Karin?
Yeah, our website is the letter U, UDirectIRA.com. And also email us. It's again, info@UDirectIRA.com. So it's you with the U, like U-Haul.
Awesome. Thank you so much.
I was thinking about this, Matt, because like if you go get a U-Haul, then you're going to move yourself, right?
Right.
So the same thing with the self-directed IRA, you're going to do it yourself. So U-Haul gives you a truck, we give you an account.
I think I see a new partnership in the future for UDirect and U-Haul right there. So
we should. I haven't thought about that one yet. But
that's awesome. And remember, everybody, do your homework. If you guys need that due diligence checklist, you can download it right from our website at MathewOwens.com with 1 T in Matthew, and make sure that you do your homework. But it's incredible that you can actually build a retirement cash flow stream right inside your own retirement, to be able to just pull that out and be able to live off of during retirement and not be depleting your principal and end up dying broke. You want to die and leave something to your heirs and not have to deplete that principal. So that means you need to find a way to make enough cash flow to survive off of long term and not just depleting principal over and over again. This concept is shockingly foreign to a lot of investors and a lot of people that are just starting out in this space. And it's super important to just have that click, because it's the key to being free. It really is. So anyways, well, thank you guys. Thank you so much, Karin. I really appreciate it. This has been an awesome discussion.
Thank you, Matt.
I think we added a lot of value for people in this to understand how they can actually take control of their future and understand the self-directed IRA and 401k space. So thank you so much for being a part of this.
Thank you.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, You can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.